And Grambell. He's a member of BKD's Forensics and Dispute Consulting Division. Rand provides business valuation services, forensic accounting, fraud auditing, bankruptcy, and restructuring services, including serving as an expert witness. He has more than 13 years of experience, also includes performing audits and consulting services for large national and international companies while with a Big Four accounting firm. He performs valuations for transactions, restructurings, material dissolutions, and income tax related purposes, and provides economic analysis of damage resulting from business interruption and breach of contract. Rand also helps identify source and use of funds through forensic accounting and provides financial consulting related to bankruptcy. And today we also have Ben Montgomery. He's a manager in the PwC technology practice with over 9 years of experience in data analysis and assurance, continuous auditing, risk management, and consulting services. He specializes in analyzing large, complex data sets and developing CATs, which are computer-assisted audit techniques for clients. This includes generating robust analytics, performing fraud risk assessments and specific audit area and financial cycle analysis. Ben has additional experience conducting internal control audits, as well as identifying, assessing, and improving revenue opportunities for clients. Please join me in welcoming Ben and Rand.
Thanks, guys. Admittedly, our bios are a little bit wordy, but I like to break it down by saying I'm a technologist. I try to develop technology tools that assist business users and address a business problem, in this context, fraud. I'm going to let Rand go through a presentation with some statistics related to fraud specifically, and then I'll ad lib with a couple of examples. I've got two other presentations. I'll try not to focus on the slides, maybe talk more specifically about some examples of how we support both financial statement audits and operational litigations and fraud litigations, where you're using a different set of tools and have a different type of objective and actually proving the fraud, as opposed to in a financial statement audit, we're concerned with financial statements being materially misstated. So.
As I say, our last presentation was standing room only, and I see we already have scared some people off. So I'm thinking if we actually presented this a third time, we might only have like 2 people sitting right up here in front. Before we get into the presentation, whenever I present a fraud topic, I like it to be interactive. And if there's questions, comments, things you've seen, things you've heard about, by all means, let's talk about them. Because I think I get a lot more out of that. Love hearing different perspectives, and I think as a group we will get more out of it if it's more interactive. So, since I want it to be interactive, I'm going to start by asking you a question. Now, one evening, a woman is standing, and we all know the sun rises in the east and sets in the west. So there she is, she's standing, she watches the sun set in the west. A few hours later, she watches the sun rise in the west. How could that happen?
Go south.
Well, she's traveling, but she's actually not moving south. Any other ideas?
She's in a spaceship.
Ah, good idea. Not quite. She is still not necessarily on the Earth, but an airplane. What kind of airplane?
Flying one?
Well, it is a flying airplane. I'm thinking of a specific name for this airplane.
Concorde.
Where is it?
Concorde.
The Concorde. That was it. The Concorde actually flew fast enough that if you were traveling west, you could watch the sunset, and then it would be traveling faster than the rotation of the Earth, so you could watch the sun rise again in the west. Obviously, unfortunately, they don't fly it anymore, but okay. So yes, this is what you're in store for the next hour. So as we start getting rolling, why are we talking about fraud? Why do we care? From business perspective, fraud is a fun word to throw around, but what is the real impact to business? Well, every 2 years, the Association of Certified Fraud Examiners goes out to the market, and fraud examiners that do this for a living, and they conduct a survey saying what types of frauds are you seeing, who's perpetrating them, how big are the losses, how are they caught, and they compile that survey and the report to the nation. 2008 was the last time this report was released, and what they found is fraud is costing U.S. businesses an estimated $994 billion. That is billion with a B. It's even bigger than the bailout, which is also a B. Big number, $994 billion. To bring that down, to make it a little bit more, put that into perspective, they estimate that 7% of a company's top line, so it's revenue, not its bottom line, but its top line, is lost to fraud every year. So real quickly, since I'm bad with numbers, 7% of a $100 million revenue company would be $7 million. Is that the right number? So can anybody think of a company, especially in this environment, that could not use an additional $7 million going to its bottom line? That is retention of employees. That's hiring new employees. That's buying equipment. That's staying in business for some of these organizations. So I would be hard-pressed to find a business that can't use this money. And what I find even more disturbing than these losses is 42% of the time when a fraud has been committed, there is $0 recovery. The money is gone. It is never coming back. And about an additional 23% of the time, there is a dollar recovery for every 4 that is lost. So now we're talking 2/3 of fraud cases. At best, for every $4 the organization lost, $1 might come back. All right? And I throw that out because from a business perspective, it is not a good investment to try to catch this stuff after the fact. The way you get the bang for the buck, where the good investment is preventing it from happening in the first place. Just real quickly, types of frauds. I like to call these top 2 just old-fashioned fraud. This is, I want to rip my company off and get as much cash out of it as I possibly can. How do I do it? Or corruption cases is, I'm going to pay bribes, I'm going to give kickbacks to my vendors, I'm going to have conflicts of interest where I've got companies set up that my organization is doing business with without their knowledge. Financial statement frauds actually get the most press because these are the ones, if you go to the next slide, when they happen, they're huge. Now, these are the Enrons of the world. So the losses are big when they happen, but really, from a frequency perspective, it's really the old-fashioned stuff that happens more often, and really that's most of the world that I deal with, is people stealing from their organizations. But I'd also want to point out that some of these asset misappropriations, I'm stealing from my company, sometimes the financial statement fraud is the end result of that process because it's gotten so big, now it is material to the financial statements, and how do I manipulate the statements to cover up what's happening? Who's committing it? Employees and managers. Just real quickly, what I want to point out on this, I think organizations do a fairly decent job of looking at line-level employees and how do we prevent them from committing fraud, but who is supervising the supervisors? Because they're committing it too, and they've got more access to assets, which actually will show up on the next slide. So we need to do a better job of watching these folks. I like to, people here, has anyone taken auditing before? Has anyone taken auditing before? As an auditor, I'm sure you've heard, you're supposed to have a healthy degree of skepticism. I have an unhealthy degree of cynicism. I assume everybody is trying to steal from me. And since I assume all of you are trying to steal from me, I'm going to try to figure out how you would do it, and I'm going to prevent it from happening. Again, this speaks to access to assets. As you move up the food chain in an organization, the top management, these are the people that have the ability to override internal controls. So when they go bad, things go really bad, and these are the big losses. Ladies, you'll like this one. So according to that, who commits fraud more often, men or women? Men. When they commit it, who causes bigger dollar losses to the organization? Men. Why?
Go big or go home.
I say, well, I like that. Usually I just like to summarize them into pigs. Women are more ethical, they're disinclined to commit fraud. What's interesting about this, if we threw up the 2006, the 2004, the 2002 studies, you would watch this gap shrinking. And I would bet if I had to, that you're going to continue to watch that gap shrink. Do you know why? Anyone?
Or women in upper levels.
Exactly. More women are attaining upper management. And as they get there, they have more access. And even though I've been told women are naturally more ethical than men, I think they're going to be committing fraud more often. Age of perpetrators, this is interesting. They're 41 to 50-year-olds. What level are they typically in an organization? I would say these are your middle managers. Remember we talked about who's supervising the supervisors? There they are. And these are the people that are committing fraud with more frequency than anybody else. So we have to do a better job of watching these folks. Again, speaking to access, your 51 to 60 or 60-year-olds, that's usually your executive management. They've got access. They have override.
Rand, I mean, given that these are younger people on that previous slide, as you age, do you become more unethical?
As you, and we'll hit on some of this as far as the fraud triangle. Yes, the older you are, the more unethical you are. No, actually what I think that speaks to is, one, financial pressures as you age become greater. Your access to assets becomes greater the higher you get in an organization, and which we'll hit on in the fraud triangle. So now you've got more financial pressures, you've got more access, and can something happen that you can rationalize taking money out of your organization? Because as soon as that third thing happens is when we run into problems. That answer?
Yeah.
Okay. All right. I like this one simply because if you ever wanted to justify the cost of your education, there it is. The more educated you are, the bigger fraud you can commit. So I think you all should be signing up for a PhD program right now. Look at what a difference that makes. And then we'll touch real quickly size of victim organizations. This slide doesn't surprise me all that much. Smaller organizations being more frequent targets of fraud. This is simply because often they just don't have the bodies to segregate duties. You might have a person who's collecting cash, making deposits, reconciling bank statements without any real supervision. So if they decide to commit fraud, they have an opportunity to do it. The next one is the one that does surprise me a bit, because as far as comparing dollar losses, they're also taking the biggest loss. They're having the biggest frauds take place. For a 10,000 person organization, if they have $150,000 fraud committed, that's not even a rounding error for them. But for a small organization, if they have a $200,000 fraud take place, that can mean they're out of business. And actually have been involved in frauds that literally put companies out of business because it's a small organization and they can't afford this. This I like to put up there simply because you'll be hard-pressed to find any industry that isn't represented. No industry is immune from fraud. No organization is immune from it. And if somebody thinks that they are, then unfortunately they're kidding themselves. Again, just types of schemes, corruption being the most frequent, and again, these are bribes, kickbacks, conflicts of interest. These also happen to be some of the hardest to catch. The next two, skimming, both billing schemes and skimming schemes, are really both cash schemes. So again, the most liquid of assets in the company is cash, also is one of the most frequent targets. All right, touch briefly on the fraud triangle, because actually we've already hit a couple of these. If you want to just go ahead and put up all three. Three things that need to be present for fraud to take place. And this was a gentleman named Thomas Cressy? Cressy is his last name. This was his theory when he was, I think, developing his PhD. And what he decided, after interviewing a lot of people that had committed frauds, came up with this notion that there has to be these three elements present for a fraud to take place. A financial pressure, an opportunity, and then they've rationalized it. So real quickly, as an organization, can you really impact a person's ethics and integrity? Most developmental psychologists will say that your personality is mostly formed by the time you're about 7 years old. So by the time you get into a business environment, this one, we can have ethics classes. I would argue that is a difficult one to change. If you're paying a fair salary, fair benefits, can you alleviate, diminish, wipe out every financial pressure that your employees face? No. So really, as an organization, here's where we have a chance to make a difference. the perceived opportunity to commit fraud and the perception that if you commit it, you're going to get caught. Because if you work, remember, I don't trust any of you. So if you work for me, I'm going to make sure you think I've got great controls in place, so you're disinclined to try to commit a fraud. And I want you to be convinced that if you so much as take a pen out of our supply room, I'm going to bust you. Those are the things I want you thinking.
In addition to being busted for it, you need to be punished.
There we go. Yeah, exactly. That I'm going to catch you, and there's going to be repercussions. All right.
The organization, on the integrity, the organization, if they treat their employees with integrity, wouldn't that leave the employees, I mean, wouldn't that reduce that? In other words, if you're treated poorly by your company, isn't it easier for you to rationalize ripping them off?
Absolutely. And we hear that, or I hear that a lot during my investigations, is they're getting even. You know, but some of that is they've rationalized it. Well, they should have paid me X thousands of dollars more than they did. So because they weren't, I'm going to get that extra money out of them a different way. But you're right. Well, one, both from hiring, have you hired the right people? And yeah, I'm treating them well as an organization. Those are important. But I just come back to, if you're basically a dishonest person, even if I treat you well, I still think you're basically a dishonest person. But again, remember, I'm saying. All right. Real quickly, after Washington Enron trials, what does a typical fraud perpetrator look like?
Everybody else.
What color are they? White. Are they educated?
Yes.
Yes. Single or married? Married. What gender? Male. Okay. Good employee, bad employee? Good employee. Did we get all of them? Yeah, so I like to say, if I was a little smarter, this is me. I think this is misleading because in my experience, in the investigations that I've been involved in, men and women, some of this depends on what position within the organization they are. Generally, they won't have a prior criminal history. That, I think, is a little misleading because oftentimes they have committed similar acts. They've never been prosecuted and have been reported. Generally, they're well liked by their coworkers. They like to give gifts. And I refer to this as the Robin Hood syndrome. They're ripping off their company, but they're going to redistribute the wealth to the people, the workers. Some of this, I think, makes them feel better that they're sharing some of what they've stolen. Gambling problems are not unusual, and say actually drug and alcohol abuse problems are also not unusual. Long-term employees, and I can't tell you the number of times it's been the 20-year bookkeeper that has absolutely ripped an organization off for thousands and thousands of dollars. We talked about rationalization of what they're doing. I'm just going to borrow from my company today because of this problem. I'm going to pay it back tomorrow, but then tomorrow comes, I don't have the money. I take a little bit more, I'll pay it back tomorrow, but that tomorrow never happens, the problem doesn't go away, and it keeps snowballing it until it's a bigger and bigger fraud. And then finally, lifestyle clues. There are very few investigations I've been involved in that in retrospect there weren't red flags present. Almost always you can look back and say, I can see this and this and this, and that should have clued me off that something was wrong. For example, I was involved in an investigation of an AP clerk. Not to disparage AP clerks, but typically they're not going to be the highest paid people in your organization. She showed up for work one day in a brand new red Jag. Nice car. She also happened to have purchased a house around the time she bought the car. But when we went back and did the record search, it was paid in cash. There was no debt against that house. $350,000 house, new Jag. She's an AP clerk. Doesn't mean she's done anything wrong. Maybe she's just inherited some money. Maybe she hit the lottery. Who knows? But, well, in fact, she was committing a huge fraud, it turned out. But there were clues. And if somebody had stopped and asked a question, maybe some of it gets caught a little bit earlier in the process. All right, so that was kind of shooting through that fairly quickly. Any questions from that? Any comments? Has anyone here worked for or been involved in an organization that had a fraud take place?
One of my managers at work actually just got fired this weekend for stealing money. He was closing out orders. I work at a food restaurant. And he was closing out orders and just taking the money. Mm-hmm. And I guess the owner of the store found out after been working there for 2 months. They stolen over $1,000. So it's pretty interesting. pretty embarrassing for him too.
Actually, I love that example, and I brought this up in the last one. If any of you are ever thinking about opening a restaurant, it's one of the most ripe environments for fraud because your three biggest assets are cash, food, and booze. And how easy is it to get any one of those three things out of a restaurant? Pretty easy. So, great example, thank you. Another one I really like is parking garages. If I wanted to launder, I probably shouldn't. Well, I'll tell you this. If I wanted to launder money, what a great environment. Because it's mostly a cash business. Who's to say that I had 500 cars parked here today, or is it 300 cars parked here today? Is somebody really sitting there and tracking cars as they go in and out? So maybe I had 300, I report I have 500, here's all the extra cash I have, now it seems to come from a legitimate source. So, another example. No other questions, comments? Anyone else seen fraud take place firsthand?
When Royal Malmark's in Denali National Park, they had a bad thing of 3 kids in the retail store were zeroing out receipts. Like if someone would pay for something. I'm not quite sure how it was working, but she was kind of telling me about it. But then they'd zero out the receipts and leave just one item on there, and they'd take the cash. And then, so they could take the money basically. I'm not sure how it quite worked, but something like that. It was a lot of money after opening this up.
Yeah, retail environment, that you see that a lot. You come up with whatever it is you're buying. Maybe I don't ring it up at all. Maybe I ring up one thing out of the 15 that you've got, and I pocket the difference.
Do you do interviews when you're doing an investigation for fraud?
I do.
How easy is it to get a confession out of somebody?
We actually, my group has a pretty high success rate, and some of that is some of the people we have involved are ex-FBI and law enforcement folks that really, really enjoy doing interviews. Can be kind of disturbing that they enjoy that process, but usually. By the time we actually interview the person we think did it, and I like to think of it as a pyramid, we're going to talk, to start with, we're going to talk to the people we think are least likely to be involved, and we're going to keep layering it. From that, who else had access, who do we think was involved, who do we think wasn't. We're going to keep talking to people that we really don't think were involved in it, to the point that we have built up, at least in our opinion, enough evidence that we have a pretty compelling case that if I sit down with you, I can start laying out document after document after document that whatever excuse you come up with, I can counter to the point that you don't have anything else you can counter with. So in those kinds of situations, we actually have a pretty high success rate.
Do you interview them with an attorney's office?
Depends. Not usually.
So they consent to the interview?
Yes.
How
Best
stupid
case,
is that on their part?
well, yeah. If we've done it right, because at this point, they don't know what we know. Generally, they are either in denial or fairly arrogant that we couldn't possibly have figured out what it was they did. So if I can get you, before you realize it'd be really a bad idea to talk to me without talking to your attorney, that's what I want. Because I'm going to get one shot at it. Because as soon as I start asking my questions and start presenting what it is that we have uncovered, if you're smart, you get up, walk away, talk to an attorney, and you never talk to us again, which surprisingly doesn't happen all that often.
Do you have a problem with the evidence holding up in court if they didn't have their attorney present?
I mean, we're going to get questioned on it, but no. All right. Some great questions. So I think now that you've gotten a little bit of a flavor for the types of investigations that we do, some of the areas, and we could talk about almost any asset on a balance sheet that is at risk, and it's everything, to be honest. And some of the investigations that we have done, I'm going to turn it over to Ben, because what we do more and more from an investigation and also more from a prevention standpoint have started incorporating some of the data analytic tools that are available that are really powerful at looking at huge sets of information and identifying some areas that either we should be focusing on that we knew about, or identifying areas that maybe we hadn't considered that we need to spend some time looking at.
Thanks. So I've got, as I mentioned before, I'm a technologist. 2 areas here that we can focus on. One is how you take an approach towards a financial statement audit, and another is how you support a litigation. I'll try not to focus too much on the slides and maybe discuss some of the more relevant examples, and again, some of the technologies that we use to manage large, complex data sets and to design computer-assisted audit techniques and do data mining and digital analysis and that sort of thing. So with that, basically, Enron was one of the examples that you mentioned, and I'll use that as an example, and we'll talk about e-discovery afterwards, and that addresses sort of the litigation. But from a financial statement audit perspective, you can use there's certain scenarios where you can effectively use technology, and other scenarios where it makes more sense to take alternative interviewing approaches. And my job is to help identify where those opportunities are and effectively utilize the tool in a quick and efficient manner, and to tune the programs to the point where I'm really going after useful information that results in a meaningful inquiry or investigation with the client subsequently. So we'll talk about, I won't talk too much about the methodologies and approach. I mean, that's high-level comments about the benefits. The technologies we primarily use are ACL, SQL Server, Oracle, and then there's some other proprietary tools that we've developed internally that are based on some of these base layer technologies. But let's see. Again, this kind of highlights just the high-level approach with your risk assessment. That's key towards utilizing technology appropriately. I mean, you've got to understand where the data is first and foremost, and how to effectively acquire the data. And whether it's financial statement audit or litigation support, you have to prove that the data that I've obtained is complete and accurate. You also have to prove that there has not been any opportunity for a term they call spoliation or spoilage of the data, so that it can be preserved as evidence in a court of law. A couple of other different approaches. So prevention, you can use technology to prevent fraud from occurring by establishing an effective control framework with respect to who has access to what data. Segregation of duties are in place. People can't do everything, and small companies a lot of times due to resource constraints, it's unavoidable. They are doing a lot of stuff. And then, CAT programs or computer-assisted audit techniques are generally designed to detect fraud. And we do that from a general ledger level and sub-ledger details, which I'll get into in a minute. And then the results of the analysis that I can provide to my financial statement auditors, my fraud investigators, ultimately leads to how they approach their investigation. Who do they want to interview? What kind of questions do they want to ask? How can I present information that demonstrates a trend?
Could I interject something, Ben?
Absolutely.
Sorry. I worked with Ben at Pricewaterhouse, and I thought maybe, a lot of what was previously presented was talking about real tangible things like, hey, I can visualize money coming out of the company to go buy a Jaguar. I can visualize kind of doing that. What's the benefit to misreporting your numbers? It's, just to kind of get into the mindset that this is a really different thing. But the magnitude is so much more. What was Enron doing wrong? They were misrepresenting their numbers. But what was the consequence? Well, the management got bonuses based on their performance in the numbers, right? They had options that they were exercising, that they were cashing out. So they were costing the capital markets a lot of money. So basically, they were taking from investors rather than from their own company. If that makes sense. So by falsifying their numbers, it inflates their stock price because people are banking on the fact that not only are they performing well, now they're going to continue this trend. And so all these investors are dumping in buying stock, right? And then they're taking that cash and they're using it to their own benefit by saying, we're great, I'm going to buy myself a mansion because I've got all this option upside. And so it's a totally different mentality, but the magnitude is so much greater than somebody that can kind of misappropriate, a little bit of petty cash, a little bit of computer, hard physical assets. So it's difficult to kind of understand when you get into, well, how does misrepresenting revenue cost investors? They're multiplying that revenue, by maybe 8 or 9 or 15 times, saying I'm banking that I'm going to pay 8 times that revenue number. So not only if I misstate it by $1 million and they have a multiple on the valuation, you've actually captured $8 million worth of value by misrepresenting the number. So it's really, really powerful. This, but it's tough to appreciate because it's not so concrete. But I just wanted to kind of make that transition because I think that can get lost a little bit when you're not, as far into the advanced accounting and the auditing classes. So hopefully that clarifies a little bit.
If I could just disagree with you a little bit, I think that was a great example. The only place I would disagree is you said it's a little different mentality. I would argue it's the same mentality. I'm stealing money from, I'm being more sophisticated in how I do it, but really I'm taking something that doesn't belong to me. And I'm using a different method to get there. But I think whether I'm stealing a few $100 out of petty cash or artificially inflating my stock price so my options are worth a lot more, it's stealing from somebody else.
Yeah, I think great contrast or great examples in the financial statement world. And my job is essentially to figure out, okay, well, what would that look like? How would somebody steal from the company? In the Enron example, they were classifying or off-balance sheet transactions and not lots of things. Yeah, a lot of things going on. But one of the areas that we do a lot of audit testing for financial statement audits is journal entry testing. And there was a pronouncement that came out a couple of years ago, SAS 99, that recommended you use computer-assisted audit techniques to audit journal entries. And ultimately, journal entries are how you impact your financial statements. Any kind of revenue, transactions, accounts receivable, expenses, whatever is going to impact that's going to impact your financial statements is going to be keyed in through a journal entry somehow. And what we do in journal entry testing is obtain trial balances that tell you, okay, what are all your beginning balances and what are all your ending balances for P&L, balance sheet accounts, etc. And then give me all of your journal entry data throughout the year, all the line items that tell me where's money going. It's going over here, it's going back over there, etc. And I aggregate the impact of those journal entries and make sure that the sum of that impact, added to your beginning balances for each of your accounts equals your ending balances for each of those accounts. So it's a roll forward. And at the end of the day, where the value added is the ability to identify non-standard and unusual transactions that might be indicative of fraud. So one example that's generally relevant in a lot of our clients is something that is classified as an unusual expense test. So EBITDA is a key metric that a lot of is aligned with management's incentives. Their bonuses are paid based on hitting their EBITDA numbers. Their debt covenants are secured based on meeting certain EBITDA thresholds. Well, how would I, if in a down economy, manipulate that number? I could potentially reclass an expense from operating expense into depreciation. Therefore, all of a sudden, my EBITDA numbers are going up. Or reclass some of your interest income into sales. It's like, oh, boom, all of a sudden net income looks great. I can do that for a material amount. I mean, based on different traps within the system, we can tune criteria that are going to uncover these unusual examples that are worth looking into a little more. Your other area of risk in that in that arena is a lot of your adjustments, your post-close adjustments, your consolidation entries. How do things all roll up? And at the end of the day, the data that I pull from the system, I want to compare and make sure that is the same data and the same financial statements that we're performing all of our other audit procedures on. And that's it's a complicated process to where a lot of things can fall out, and management has the greatest opportunity to override the control framework that exists to commit fraud, essentially. So that's one journal entry testing example with Enron and the off-balance sheet transactions. If the auditors were in fact doing that, making sure pulling system data, rolling it forward, making sure it was complete and accurate, making sure journal entries, balance, the debits equal the credits, etc. And then at the end of the day, comparing the trial balance, the chart of account that they're considering to what the auditors are looking at. Most likely, they would have identified some transactions going on that are impacting accounts that they're not auditing, and that would have been, hang on. Let me go look and ask about these accounts and figure out whether or not they're being handled correctly. So, and the use of CATs and technology has been pretty effective in trying to address that, because otherwise it's pretty challenging to uncover that stuff as we've seen emerge.
The example that Ben was giving, I think, is a great one, because one area that I might look at and might use some of the tools Ben alluded to is if I have a notion that a fraud's taking place and the financial statements are being used to hide it. Let's say we run a query and say, show me every balance sheet account that at the beginning has a zero balance, at the end has a zero balance, but has activity in between. So from an audit perspective, it doesn't exist at the beginning, it doesn't exist at the end, but we know that there's transactions being run through this. So show me all of those accounts. And once we have narrowed our search to those accounts, now we can start looking at specific entries. Is there anything that we see in there that causes us some concern? If it looks like it's routine activity and it makes sense that this would be a zero account, for example, you've got a cash account that's swept every day. So cash goes into it, it's by design. At the end, the cash is gone, so you expect it to zero out. Okay, we feel pretty good about that. But are there other accounts where that kind of explanation doesn't make sense, that really we would expect there to be a balance? The activity would lead us to believe that there should be something in there at the end of the period. Now we really want to spend some time looking at that.
Absolutely.
Ben, I got a question for you. You're more of a systems IT type person. How'd you learn all your accounting? Just on the job?
A lot of on-the-job accounting. I mean, my general business degree in undergrad, but yes, I'm not a CPA. Certified information systems auditor and certified information security manager. But yes, I think a vast majority of what I've learned has been on the job. And we've had previous discussions about, is it better to learn the technology and then accounting, or is it better to learn accounting and then the technology? And I think it's a good, interesting debate. I think it's when it comes down to it, a good, dangerous combination to know both. The technology will teach you how to do stuff, how to get at certain information. The accounting and finance aspect of it is, I think, equally important, because it helps you evaluate, well, so what? What's the impact? We go back and forth as far as where is it more effective to use technology, and how do I make sure that I'm using technology most effectively to address specific risks. And therein lies, where the rubber meets the road and how you can add value. And that's what I spend most of my time focusing on, and making sure I understand, my client being either, my financial statement auditors or, litigation support people. What's the risk? What's most important, and what, and that helps me determine how do I design tests and carve out information that's going to be that's either going to confirm or refute an expectation, or test an expectation and present some evidence. So. Any other questions? Okay. Again, I said I wouldn't focus too much on the slides. I mean, just some of the examples of the techniques we use. We can look for some duplicates in subledger testing. So like AP, you might look for duplicate vendors or different vendors with the same bank account or PO box number that people are diverting funds to their own account. Digital analysis. Again, this is sort of like Benford's law is something we can that states that a statistical data set should have a normal distribution of leading numbers, and if that doesn't prove out, it might warrant a little further investigation. Some trends like revenue analytics, and you can do the same thing on expense. Helps you identify anomalies. Parallel simulation is kind of comparing two different data sets. This talks about our approach. This is consistent between financial statement and litigations. Validating completeness, accuracy, validity of data, and is where we spend a lot of time doing and presenting results. So these are different phases of planning, validating the program, executing the program. I like to think of it as a life cycle of continuous improvement. It takes some investigation or investment up front to establish these in place, but the real value is in tuning it and again, making sure it's addressing a specific business risk that's constantly evolving. Consideration, preliminary analytics, pretty key. Data acquisition's pretty key again, just validating stuff. These are just some examples of some of the fraud schemes. Sales and receivables, theft of cash receipts. We had a lapping example in our earlier class. Disbursements. On the disbursements and AP side, we do some testing related to unrecorded liabilities in the AP world, where we basically join cash disbursements with an AP balance file, and anything that doesn't match up is an at-risk population of a liability or a payment that was issued after your cutoff period that maybe perhaps relates to an expense that occurred during the period. That's one example. We do some AR liquidation testing to help you get comfort over your reserve account balances and your AR balances as well. A lot of different examples. Inventory, I think, is down here. You can recalculate. I mean, your inventory should be valued at the lower of your cost to market. Based on different data systems you can pull, you can evaluate, like at a discount retailer, maybe. You've got X number of units that have sold for $5 a unit over the last 3 months. However, on your books, you bought them at $8 a unit, and that's where you've got them valued. That should be adjusted depending on the quantity. So, a lot of different ways you can use data to prove out different accounting pronouncements. So ACL is one of the tools we use, stands for Audit Command Language. SQL Server is another one. A lot of these tools integrate with Access, Microsoft Access, Excel. A lot of the outputs generated are Excel spreadsheets because they're easy to follow up on and perform subsequent analytics on.
As far as ACL, one of the things that we do a lot of. Talking about the tools that Ben was just going through, what we will do a lot of is looking at vendor master files for a company and comparing that against employee master files. Do we identify instances in which addresses are the same, phone numbers are the same, tax ID numbers are the same, and where we've got matches, and we're looking for fictitious vendors. So a company that somebody has set up that they're diverting money to that isn't actually doing business with the organization. We actually have also started doing what we call some concentration analysis, and I was talking to Ben about this. And what happens is we'll convert an address to a GPS coordinate, and then we'll take that GPS coordinate and we'll actually plot that on a map. So we can throw up a city map and say, did we realize that we have 15 vendors concentrated within one city block of this single employee? Does that cause us concern? And what's powerful about that, again, is you can look at a picture like that and within 30 seconds say, here's the 3 things that I see that cause me concern. Whereas if I'm just looking at street addresses, unless there's an exact match, I may not be picking up on the fact that they are really that close to each other. So again, the stuff that Ben is talking about is some really powerful tools to look at a lot of data quickly, and again help us refine where we think we're at risk and what we should be looking at.
Mm-hmm. Absolutely, and it's all about. At this point, we've established a library of tests, of standard tests that we can use to address different scenarios in the listed above, but where the value is really added is understanding which ones of those apply to specific situations, and presenting those results quickly in a way that facilitates the follow-up and further investigation. So this just talks about kind of the ACL process. This was the Benford's Law analysis that we indicated. There's a normal distribution of leading digits. Back to the journal entry example, this is a particular SAP system where a lot of these entries come from the source type SA, which is kind of how you define a manual entry, which is going to be a little bit more at risk. The control framework for how you post a manual entry may not be as robust as some of your automated entries. You can also drill down into AP, AR, etc. if need be.
So actually where we use that some as well is, do we see journal entries that were posted on a Saturday or Sunday? Do we see journal entries that were posted outside of normal business hours? And then we can match that up to saying, can we look at journal entries by user code? Mm-hmm. So we have this one person that's posted a whole bunch of entries on Saturday or Sunday or outside of business hours. I think we want to look at those a little bit more closely.
Mm-hmm. Or you can use a cross-section of, this user is an AR clerk with certain roles and responsibilities. Why might they be posting entries to AP? If that violates some sort of segregation of duties rule or expectation that's been put in place. Let's classify on source again. It's just a different way to display the data. Classify by the amount. And again, these are just results of kind of the Excel spreadsheets that we'll be generating. The fraud monitoring workbench is similar analytics with a different graphical interface. It's based on SQL Server. And again, you kind of go through the same sort of process, but we'll display results. This would be a web-based form that I could access and Rand could access and Heath, we could all access and go in and do different types of scenario analysis and generate some of these dashboards for monitoring. That's about it from the financial statement sides of things. This talks just about how great we are. But I can. How much time do we have left?
About 5 minutes.
Okay. The other area that I can speak to, and again won't focus too much on the slides because it's 81 pages, but is the e-discovery world, and this is where we. But you can leverage technology to support litigations. Different technologies on the data analytics side, you can still use the ACL and SQL Server. Oracle is another database that we use, similar to SQL Server, but slightly different. In this arena, you're more concerned with harvesting data out of systems. I'll forward down to the definition of e-discovery, first of all. These are just some of the cases that came through, impacted where we are. Okay, here we go. So, electronic discovery, so what? Why is it a big deal? Well, in a lot of these court cases, what's on your hard drives, what's in your ERP system databases, your phone calls, your emails back and forth are all evidence that is obtainable through subpoenas in the court of law and can tell a story. How do you get to it? How do you acquire it, preserve it, analyze it, and produce some evidence is ultimately what the e-discovery process is all about. So, some of the examples is collecting data and emails, common user files, what's on a shared drive, and how you might wonder, well, it's on a shared drive. How do I know? How can I get any information out of that? Well, there's metadata within the files of the shared drive. It's basically like the DNA characteristics of each of those files that can tell you, okay, who created it, who last edited it, copied it, what dates these different events transpired, and what exists within the document. So you can actually go after specific files and identify, well, where were they copied? Who took this highly sensitive piece of intellectual property from the shared drive and emailed it to their Hotmail account? All this is part of the what you're trying to address in the e-discovery process.
Let me throw out another example real quickly. This is actually a huge issue. As more and more information in organizations is electronic, in a litigation or even a fraud investigation perspective, this is a big deal. Because let's say, for example, what's your name?
Becca.
Okay, let's say I think Becca, who's an employee of mine, is running a meth lab out of her house and is actually keeping her sales in an Excel spreadsheet. And believe it or not, we actually were involved in this investigation. So I think she has sensitive data on her computer that's at work. I walk into her office. I think she's got information on her hard drive. So what do? I boot it up to see what's on there. I have just compromised everything that is on her computer. Because the number of changes that happen to the information, and actually Ben could speak to this more than I can, who's to say if I try to now take this into court that they say, well, Mr. Gambrell, you created this spreadsheet. Because we can see that this file was last altered when you booted up the computer. Who's to say this was Becca's worksheet? So again, how do we maintain custody of evidence? How can we reflect the chain of evidence? Can we produce something that says, no, we imaged the hard drive before we touched anything, so Mr. Defense Attorney, here's the hard drive, and we've got 3 other copies of it, by the way, so we can confirm the fact that the information I'm going from is the original data that we never manipulated. So again, and as you're talking about bigger and bigger data sets, it is really a huge issue.
Yeah, so the process by which you go about obtaining that information has very strict protocols in order to preserve that chain of custody and prevent the spoliation of, I could have gone in, manipulated the spreadsheet or planted it on your computer, and therefore it's inadmissible. And there's certain protocols that you can go through to prove that didn't happen. So that's part of the e-discovery process. I think we're running out of time, but real quick, this kind of talks about how we obtain everything and distill it into meaningful information. This is really, again, the process of identifying, preserving, process, review, and produce. Very similar on the financial statement side of things, where I'm using different tools. I think it's a little bit more specific on the preservation side, because you have these chain of custody and spoliation issues. But at the end of the day, how do you go after information? How do you leverage technologies to address a business risk? We could go on and on for days, but it's a fast-growing environment, and I'm excited to be a part of it. But a lot of information here. But I think we are running short on time, so I'm going to say thanks for having us. And any other questions?